Do inflation, unemployment, and eviction moratoriums threaten the future of multifamily? We're speaking with economist and developer Gary Banner to get his thoughts. I'm David Grana, and this is Real Talk. Gary Banner, thank you so much for joining us today.
Thank you for having me again, David. Thank you. It's
So,
great to be here.
so glad that you were able to join us. We're very lucky to have you because of two things. One is you're an economist, so that's really good news. You can explain away what's happening in the market, and you're a multifamily developer, so you can explain away what's happening or what the outlook is for the multifamily market. Let's focus first on the economy. What are your thoughts on what the economy looks like, the economic environment looks like from your standpoint?
Well, today it's obviously the U.S. economy is very challenging. We have a number of crises occurring at the same time, which is typical of a crisis cycle, by the way. And we're just going to have to get through this down period and get to the other side of vaccine taking and recovery in business. Until that time, we have to be diligent and plan ahead.
Fair enough. And as a multifamily developer, keeping all that in mind, which asset classes or sub-asset classes within multifamily do you feel are at greatest risk while we go through this transition phase of getting the vaccine, figuring out the economic landscape?
Well, pretty obviously, you have your classes A, B, and C. C being the older properties ranging from, let's call it 1980 through 1960s. Your smaller properties, less amenity, lesser locale. Those properties are at the greatest risk today. Fortunately, the United States government has put on a rental moratorium for eviction, and that is really helping those properties at the lower end. You do have people in place. Their collections are running roughly 89 to 85% collections. So not as dramatic of a downturn as what occurred in 2008 and 9 because of the moratoriums, but they are at the greatest risk. That demographic that rents the Class C apartments are your essential workers, and they have been they've suffered the most through the pandemic. So they need a lot of aid today, and Congress and the Senate are working on those packages as we speak. But it's vitally important to the Class C renter and the Class C apartment owner.
Are a lot of these landlords suffering? I mean, I know you mentioned a very high pay rates of about 89%, 90%, but are some of these Class C apartment owners going through some difficulty or some challenges right now, especially if you're talking about those that own multiple properties that are going through this situation?
You know, I think it's really interesting question that you're asking. So I was with a buddy who invests in Class C apartments, mid-size apartments throughout Clark County, Las Vegas here. And he's doing surprisingly well on his collections. He's still doing value add work to improve the property and increase his rents. And he's able to capture those rents. I think right now, and a lot of us are surprised. We thought a lot of people would be evicted and be on the street. That's not happened. Rents have firmed because of that. Las Vegas experienced a slight uptick in rents, maybe 3%. And that's a complete surprise to everyone. I don't know if the full effect of this pandemic downturn has been experienced yet. When businesses start in counties and governments start to reopen, I think we'll know then where the new level is. Right now it's kind of masqueraded with all these programs, stimulus checks, et cetera. We don't know where the real bottom is yet, but I'm concerned.
When you say we don't know where the real bottom is as of yet, do you have any idea, or does the industry have any idea as to what the expectations are for when we might experience that?
Well, I'm listening to Wall Street and CBC commentary most daily, and a lot of the analysts are starting to stretch out the recovery expectations. Last December when this pandemic first started, everyone was thinking the end of 21, we would start to march on recovery, and the stocks responded accordingly. Now that date is being stretched to 22 to 24. And so what's the real reality? We'll know probably in the next 2 quarters what is realistic. I'm still sticking with the 22, the end of 22, and I did a real estate cycle analysis, not with the pandemic in mind, but just pure real estate cycle work. So the recovery is going to be different. There would be pockets that perform better than others, as in all recoveries. Different assets respond differently. And I think that'll occur in multifamily as well, where you have your class A, Bs, and Cs respond differently to the recovery.
Which of those sub-asset classes do you think will have a better response or better chance of bouncing back and getting to a sense of, let's say, 2019 figures quicker?
Leadership always comes from class A communities. The recovery always begins with them, and the cycle ends with class C. So this is a correction that I projected back in 2012. I was expecting this type of correction for 21 and 22, but I think coming out of this correction, you're going to have a lot of class B value add take off. People will see the opportunity. They won't have time to develop a new project from ground up. So on this phase of the cycle, class B will take the lead, and it'll end with class C finally getting lift off as a laggard.
Now, you'd mentioned that the recovery is going to take a bit of time, at least the timeline is being stretched now by the analysts. Does that also include, do those projections include more moratoriums? And if we're seeing in Class C 89, 90% rent payments, will we start to see potentially those figures start to drop a bit and maybe a bit more pain for the landlords and the developers?
I hope not, and I don't anticipate that. As I said, we're going to have a mixed recovery, a K-shaped recovery, if you will. If you're familiar with that, the K-shaped recovery, I think that's going to continue for a while. I think we'll climb out of this cycle, but there will be winners and losers in this recovery. On the K side, on the upper arm of that recovery, is going to be Class A, professional workers, gainfully employed. They're going to recover and invest first. And then as that momentum, that economic momentum gathers speed and gets to the other demographics, you're going to see them lift later in the cycle.
So when we're talking about the sort of the downward leg of K, that would be potentially, especially in this market, like casino workers, who a lot of them who have been furloughed, unemployed, or maybe some of the, if you will, lower income workers here in the community.
Yeah, so we do need to strip employment back, and that goes right along with McCarran Airport visitor traffic. That's the metric that we all should be looking at and focusing on. The airport and the convention center, obviously. Hopefully it opens up in 22 and able to have conventions again. Those are the economic drivers of this valley. And we need to see visitor count go up, and we need the convention center to start having conventions again. But going forward, as I said, it'll be a mixed recovery. Your better locations and your better property will take off first, because the people who rent those are gainfully employed. And that's the name of the game. Right now, too, for the past year, we've experienced an influx of remote workers. These people are not essential workers, they're remote workers in the tech industry, finance, law, etc. And they're able to work remotely. Las Vegas, Clark County, we've picked up, I say on average, anywhere from 10 to 30,000 in net migration due to remote work, according to Yardi. I believe we have that slide, and feel free to bring that up. You'll easily see the depiction where Las Vegas is a green dot. And in the legend, that green dot represents anywhere from 10,000 to 30,000 net migration for remote work. So that's one of our advantages. You have a high-priced metro right next door, Los Angeles. That's helped feed this new influx of net migration. Will that reverse? I don't think it will completely reverse. It will slow as recovery happens in Los Angeles. But it will. Our market is very sticky once you move here. You probably experienced this yourself. A lot of people who moved to Las Vegas felt it was a transitory move for them and it was only temporary. And 10 years later, they're still here. And Las Vegas has a knack for that. It's very sticky when you migrate here. So I don't envision to see any net losses on recovery around the nation. I think it'll be sticky and those populations will stay. So that'll be a great benefit for us.
And presumably, as if we do see increase in income taxes, which California seems to be rather healthy right now, but and there's no talk about that. But if we do see an increase in state income tax in California, would you project that will become even more so attractive because of the relative advantage that we have with no state income tax?
Well, I mean, I think that's a big part of it. It's probably the economist's answer to it. But I want to give you something a little more anecdotal based on that. I would like to say, looking at the population growth and the recovery, the job recovery that's going to have to take place, we're going to be more attractive for employment and wage growth. And what's occurring on both coasts is the migration out of the coastal cities inward to the inbound or interstate, Midwest, mountain regions. We're going to be growing the fastest in net migration cycles or momentum, if you will. They just don't turn on a dime. They tend to draw out for a decade or more. So I think this is really going to be a net positive for Las Vegas in the long run.
And do you feel like this is probably a decade-long process where we continue to see this population growth trickling in? I mean, right now it feels like a deluge. It feels like we're just getting so many Californians. But do you think that it'll be sort of more consistent and probably not as higher numbers as we've seen over the last year?
Well, I always like to compare us to Austin. At least I like to hope that we can perform like Austin. Austin, Texas, that is. You know, a lot of Southern California and Northern California companies are still moving to Texas. Even today, they are still going in droves and they're bringing employees with them. I like to see us get some of that traffic. We will never get all the traffic that's going to Texas. But when you look at Austin, Seattle, Oregon, these other Western regional cities, they've already had an influx of population. Las Vegas is really your last chance this close to Los Angeles and Phoenix, and still affordable with no income tax, no state income tax, that is. So I think those are very good fundamentals going forward, and it'll help us with this recovery and carrying out throughout the real estate cycle.
Now we see a lot of multifamily projects that are underway right now, and if you just drive down the 215, there's plenty going on. You drive even up and down Las Vegas Boulevard, you've got a number of projects there. A lot of them seem to be Class A, so commanding higher rents. Do you feel that we run a risk of possible oversaturation, particularly at that price point, at those price points?
That's a tricky question. And the reason why it's tricky is because of the net in-migration with higher incomes. So, for example, in the Southwest here, along the Las Vegas Boulevard South, a new property by the name of Tuscany Highlands, I think I can say that legally. Tuscany Highlands have an income demographic that runs north of 100,000, probably as high as $500,000. as renters. They're choosing to rent. Now, there is the other side of the coin. Well, Gary, there's not enough property out there to buy, so they have no choice but to rent if they're leaving that market. That is true. But as I said, where you reside is sticky. People don't like to move too frequently. It becomes sticky, even as a rental. And if they have all the amenities and trappings at that location, it's going to be a sticky location. That property today is 100% occupied, as I've been told. So that's the power of this net migration and remote working. That income demographic for that tenant profile can afford those rents, and they are an option for them. Now, on the other side of the K recovery, you have the middle income and the lower incomes. Those are going to need assistance, federal tax credits, things of that nature. The Class C mom and pop owner, he's part of the affordable housing stock. Even though he's not under contract with the state of Nevada Housing Division, I consider that part of our affordable housing stock. Those Class C small properties, mom and pop ownership, they're vital to this market. A lot of those properties are reaching obsolescence. And it's either put 20, 30,000 a unit into them, or they're going to continue to lose marketability. That's part of the K-shaped recovery. The well-located Class Cs in their downtown cores that you can doll up and put 25, 30,000 unit into them, those are the ones that are going to rally toward the end of the cycle. That's how I'll know the cycle is close. So I like to very briefly go over the Banner multifamily cycle, how I came up to it. I'm sure you're going to bring up an image to this effect. I'm going to turn my eyes down just to look at my notes briefly. How I came up with this cycle was after the 2008, 2009 market correction here. That was national and local. Your typical correction lasts 4.4 years in an 18-year real estate cycle. Here locally, we began our recovery in 2013. So my first market momentum correction was 15 and 16. We had a slight tick, but the building kept right going because it takes 12 to 18 months to plan your project, and it takes 2 years to build it. So you have people who started their projects in 2013, 14 are actually starting construction in 15. No problem, no worries there. That's just a minor correction. My next projection was for, believe it or not, 2021 and 2022, where we are today. I had no idea about a global pandemic when I made that projection.
So these figures we're seeing here are without the pandemic in mind.
That's correct. This is solely based on Las Vegas's real estate cycle that I did homework for in 2012. So from 2012, I projected all the way to 2026. And apparently this, my model that I projected is highly correlated to what the market is doing today. So my 2021, 2022 correction is right on point where we are. Who's going to recover out of this first? I think, of course, naturally Class A will get its share. I think Class B value add will take off with Class C well located to end the cycle in 26.
Is there any need to adjust the 2022 figure to be a bit lower because of the recovery, or do you think these figures are pretty accurate?
That image that you just shown on your screen is pure momentum of price. So I'm not projecting price, I'm projecting the momentum of it. So what I'm expecting to happen in 21, 22 is sales to dry up slightly and to have some rent concessions in the market. And that's exactly what's occurring. In the background, you have this national pandemic eviction moratorium at the same time. So this is just purely a momentum projection of prices going forward. Not so much as price, but what it correctly projected is the momentum in the market with the rents and the sales volume, which was spot on.
Now, interestingly enough, right now, in order to get first off, in order to buy a property, a residential property, you're dealing with multiple offers, you're dealing with cash offers. Very similar situation to what we saw in the run up to the 2008 financial crisis, mainly because of a lack of inventory. It has nothing to do with dodgy loans, let's say, for lack of a better expression. So we're seeing lack of inventory. It's very difficult. And yes, you're absolutely correct. As a result, people are now relying on rentals. The rental market is incredibly tight. A lot of the landlords are making it incredibly difficult, and there's more hurdles to jump over in order to be able to get into a rental property. But you're saying that potentially, as we get later and later into this pandemic cycle, we may start to see that soften and maybe start seeing some, let's say, some concessions, if you will, to try and attract people back into the rental market. Is that correct? Is that fair to say?
It's fair to say, because the market it may be artificially tight due to the moratoriums. That people can't move around. You have moratoriums in units where tenants aren't making the rent. When that's off, that unit vacates, and now you have movement. There's room to move. So right now, particularly in the single family rental market, it's a landlord's market, and they can dictate their terms and their rents. And a lot of people are looking to get out of smaller space into more spacious environments due to the pandemic. They need to work from home, remote work, etc. So that's playing right into the hand of single family rentals. So they have a command on the market today. But as the market recovers and building resumes, they're going to lose some of that pricing power due to more supply coming online. Now, I have to say, since the last recession, Las Vegas market, we have not been able to build fast enough to match the future demand. We need to deliver at least 6,000 units per year in this market to meet the affordable aspect of it, just to meet that. And I think we built in 2020, 4,800 units were delivered. I believe I'm correct in saying that, 4,800 units. We haven't been able to approach that 6,000 units a year. So we're going to have tightness. And then we have a moratorium. We have an eviction moratorium on top of it. So the market is tight to some extent, and that's why we got a slight uptick in rents, 3%. It beats going down. And how is that an artificial tightness? What will we see once the moratoriums are lifted? That's the question. I think the bleed will come from the lower end, Class C, because that's where the most pressure is. And that's where a lot of affordable housing needs to be delivered. And so I'm sure new affordable housing projects will be delivering, and they're going to go for it. So that's where I see the biggest risk, is the lower end.
And just an observation on the supply of SFRs, of single family residences, is it's quite possible that as mortgage deferments come to an end, which we're coming on a year for that. As that comes to an end, we may potentially start seeing people in a position where they may not be able to continue making or start making their mortgage payments and then put those properties on the market. Do you think that will also kind of start to loosen the market up a little bit as we start to see more people, particularly in the lower income bracket, start to put more properties on the housing market?
Well, when I answer that question, I'm going to throw you a little curve. I'm also looking at what potentially could happen with inflation. So if you have people losing their homes to foreclosure, they're probably going to be snapped up pretty quick by home buyers, because we're probably stepping into an inflationary environment. And wouldn't you want to take mortgage debt at 3% and have inflation kick up 3%? I mean, your mortgage money is almost free now. So I think there always will be demand for home ownership, but there may be lesser people who qualify for it.
On the topic of inflation, which is a hot one. I mean, that's the dirty I word that everyone has been talking about right now, and whether you're watching CNBC, Bloomberg, or even some of the local news channels. Multifamily and really real assets as a whole are an amazing hedge against inflation. or have been traditionally anyway, because you can always raise rents. Do you think we'll start to see more large investors coming into the market and opting for multifamily and other real assets, particularly commercial assets, as an inflation hedge?
They're already doing it, and they're already here. And in fact, there's probably a plethora of family offices with dry powder waiting to get in the market because they see this inflation coming. Just take a look at commodity prices. Timber, a major component in multifamily and single family development, timber, that's going up 250%. No inflation, timber is up 250%. Look at copper today. I think we're at $3.36 a pound. I mean, it's starting to get lift. But wait a minute, I thought we were in a pandemic with all these businesses shut. Real assets, real commodities are getting lift here because we have M2 out of the Fed screaming vertical up. So that is going to bleed into real prices. We're going to get some inflation. Real assets like real estate, rents, multifamily, they perform extremely well with expected inflation. Unexpected inflation is hard for anyone to take. Any asset other than gold and silver, unexpected inflation. So as long as the Fed is out front and saying, we've risen our inflation target at 3%, it was 2, it's now 3 or 4, that's expected inflation. Real estate will perform well, and so will stocks. It's the surprise inflation that hurts everyone because our expenses go up too in apartments. I have a bottom line. I have to operate the property. I'm going to see inflation on the expense side of my ledger. Can I pass that through to the tenant? We're going to pass through. We're in real estate investing. If inflation is going up, my rent should be going up because my cost is going up. Now, hopefully my cost goes up at 2.5%, and my rents go up 6%. That's how we make money in apartments. So I am welcoming expected inflation. I'm afraid of unexpected inflation, which is called stagflation.
Are you also somewhat afraid of inflationary pressure along with, hopefully not, but along with continual economic weakness? And by that, I'm talking about the Las Vegas Strip, unemployment levels, etc. I mean, you get to a point where, yes, you can start raising the rents, but it also becomes a point where people start looking at it and saying, I had my job at the Strip, I'm furloughed, I don't have any income coming in. Now rents have gone up by 6%, 7%. Maybe it's time to look at somewhere else, maybe a Texas, maybe in Arizona, to be able to get the job and be able to afford the apartment. Are you at all concerned about those two situations kind of coming together in a perfect storm?
No, I'm not, because I know if we're raising our rent 6%, the other markets are raising their that much or more. So, I mean, still Las Vegas will be a value proposition to those who work and live here because, yes, we're going up in price, but other markets are going up faster. And why do I feel that other markets will go up faster? Because they'll have a stronger job growth. We need more, we need to diversify our economy here in Las Vegas. We've been making strides at it. We have since the last recession. I think we're up maybe 7 basis points on the diversity index because of it, but we need to do more. We need to diversify more. And, with that comes the jobs, and jobs is the growth. So we need those things. But I think as far as people being priced out of Las Vegas, I don't see it, not in the Western region. You'll have to go to the Southeast. Maybe you can go to Atlanta, or some markets like that where you can get a price break and the jobs are there. But usually when you get a price break in your rent, the job's not there. The rent goes with the job. So that would be my answer. I don't think you'll be priced out of Vegas.
Well, that's good news, and that's promising for our economy and for our market. I hope that we are able to attract a lot more investor capital here and get more projects online. I have had conversations with the home builders. They've had difficulty keeping up, and their anticipation was that this pandemic was going to negatively affect their market. It's done the opposite. Demand has only increased. So I hope that they're able to keep up with demand, and that the multifamily builders are as well.
Yeah, absolutely. I mean, we're all juggling the increase in cost, and we're trying to project where rents will be 2 years from now. I can honestly feel that in 2 years from now, this market will be recovering and rents will be lifted. I think we did north of 21% since that last recovery, cumulative rent growth. It may be even higher than that. So the money is in the rents. There's no doubt about it. Investors that are able to withstand the 2-year event, which always occurs in your investing. There's a recession every time. If you can hold through that 2-year event, on the other side, you're likely to double your rents. And that's what makes this investment worthwhile.
Well, I hope that people watching this video take note of it, and that they look at your multifamily cycle model and invest accordingly. Gary, thank you so much for your time. I really, really appreciate it. This has been really informative.
Thank you for yours as well. Thank you.